I think this year, and it can spill into the first part of next year, I have a target on my gold of 3,000.
Mm.
I'm likely to raise that by several $100s. I think it's conservative at this point, given that gold's at 2,500. My silver call is $75. It had been 60, and I raised that in my last letter. So I think silver can go to 75. Let's say between now and the end of the first quarter. Um, and gold to 3,000. I wouldn't be surprised if it's several $100s higher than that.
DavidHunter forecasts that gold could exceed $3,000 per ounce by early next year, with silver potentially reaching $75 per ounce by the first quarter. While Hunter's official gold target is $3,000, he anticipates it might surpass that level by several $100s. In alignment with these predictions, Chris Gaffney, president of world markets at EverBank, also expects gold to hit $3,000 eventually. In June, Gaffney predicted that gold would surpass its previous high of $2,450, which it achieved last week. However, he notes that the exact timing for gold to reach $3,000 remains uncertain. Gaffney highlights that while lower interest rates and ongoing geopolitical uncertainties could push gold higher, he does not anticipate it reaching $3,000 this year, which would require a 25% increase from the current price. Meanwhile, DavidHunter cautions that the economic landscape could become increasingly challenging, with global debt potentially surging from $320 trillion to $500 trillion following the current boom-bust cycle. Hunter also predicts that U.S. interest rates might rise in tandem with inflation, possibly reaching 15% to 20% or even higher. The Institute of International Finance reports that global debt, which includes borrowing by governments, businesses, and households, will hit a record $307 trillion in 2023. Despite some easing of recession concerns, the World Economic Forum's latest chief economist's outlook shows that 60% of chief economists expect a weakening global economy this year. The sharp rise in inflation has driven global debt to unprecedented levels. Before we dive in, please like this video, subscribe to our channel, hit the bell icon for notifications, and share it with anyone who might benefit from it. Your support helps us bring you more valuable content.
I think all base metals will go through the roof. And gold, I think, can get to 20,000. Silver can get to 500. It'll be it won't be there long, might last a few years, but it'll create a problem because not only do we have 320 trillion in debt now, we are probably going to go to 500 trillion in the bust or soon after the bust. So we'll have 500 trillion in global debt, and interest rates will match and will be following inflation up. In this country, we'll be looking at 15 to 20% interest rates or higher that we can't service now at 5%. It leads to something very dire, a depression, far beyond what we saw in the 1930s, out, let's say, in 2033, 4, 5, somewhere out there. And I think this year, and it can spill into the first part of next year, target on my gold of 3,000.
Mm.
I'm likely to raise that by several $100s. I think it's conservative at this point, given that gold's at 2,500. My silver call is $75. It had been 60, and I raised that in my last letter. So I think silver can go to 75. Let's say between now and the end of the first quarter. And gold to 3,000. I wouldn't be surprised if it's several $100s higher than that. In the bust, almost all assets will go down except maybe U.S. Treasuries and cash. In the bust, I think gold can probably, if it goes, let's say it goes to 33, 3,400, it might come all the way back here, back to where it broke out, 2,100, 2,200, somewhere in there. Silver at 75, it could easily come back 50%, maybe 75% from there, because it's a much more industrialized, demand-driven commodity. So I think they'll get hit hard if the stock markets hit 80% and silver drops 70%. You've outperformed them, but it's a big hit, right? So, and I don't know that it'll come that far. It might only go 50, but it's not something that you can just buy and hold and say, I'm not worried about the bust.
DavidHunter forecasts that inflation could rise to high single digits by late 2026 or 2027, potentially reaching double digits by 2028, and possibly exceeding 20% by 2030. He views this scenario as part of an 80-90-year supercycle, extending from the Great Depression to a possible depression in the 2030s. Amid these inflationary concerns, McKinsey's 2022 analysis predicts that annual U.S. healthcare expenditures will rise by $370 billion by 2027 due to inflation. In contrast, Yilmaz observes that we should start seeing annual reductions in inflation from the middle of next year. Monthly decreases have already begun, and the monthly increases from last summer have ceased. The trend is moving towards lower figures, with the annual impact becoming evident by mid-next year. Yilmaz hopes to see single-digit inflation by 2026. Let's get back to the interview.
When you're faced with a free-falling financial system, which is what I'm describing, is why I say it's going to be even worse than 2008-9, you're going to have bank failures dominoing across the world. You're going to have all kinds of corporate issues, real estate issues, etc. And again, it's global. Every central bank in the world is going to be deer in the headlights saying, what do? We got to print money. We got to pump this thing up again. They're going to start trying to be disciplined. We're not going to put 5 trillion in. We're going to only do a couple trillion. And they're going to find that didn't stop anything. So then they do another 3 or 4 trillion. That didn't stop anything. Ultimately, I think what it will take to bottom this thing out and turn it up will be perhaps $20 trillion coming out of the Fed. So, our balance sheet got up to 9 trillion. We blew it up by 5 trillion back in the pandemic, back in 2020, 21. We're going to see 4 times that, in my opinion, and proportionally around the world, all the central banks will be doing similar, not the same numbers, but proportionally. And so you will have money coming out of everywhere and being matched by fiscal. We'll be issuing new treasury debt like crazy to match that, and they'll monetize it. With a lag initially. And the reason they'll be doing that is to try to, stop a free falling system. The lag to when that turns into inflation is probably 18 months or more. So into any kind of serious inflation, because we'll be in deflation next year, I think. Mm-hmm. Next year is going to be, once you hit this bust, it's going to take us into deflation. So they'll have the infinite ability to print money, because the lag to when that shows up as inflation is a couple of years out. So they're going to be faced with, they're not going to be worrying about inflation. They're going to be worrying about saving the system. Once they print that kind of money, with that lag by let's say the second half of 26 or 27, inflation's back up into, higher single digits. I don't know whether that's 6 or 7%, let's say, moving towards double digit. By the time you get to 28, I think you're well into double digits. By the time you get to 2030, in this country, it'll be, I think, well over 20%. Again, it's because of those leads and lags, and we're at the end of what I call 80-90-year super cycle. That I define a super cycle as that big cycle between 2 depressions. Mm-hmm. A depression in the 1930s and a depression in the 2030s. Next year is not a depression. Next year's it's going to be straight down and straight back up. It's going to be a V, but it's going to be, while you're in it, it's going to feel like a depression. I think you can have an 80% decline in the stock market, an 80% bear market from the peak. So if we get 7,000 on the S&P, it can fall to 1,400. And again, I'm not going to be precise, but I mean, that's just to give you an idea of what I'm talking. And then from there, that money that will be printed will, they'll be coming up with every program they can, just like they did in 2020, to help the consumer, to bail out pension funds, to keep the money markets up, et cetera. That money will find its way into assets. We will see a commodity cycle following the bust. So beginning in 26, probably later 26, and all the way through the balance of the decade, you could take oil to $500. I think oil next year can get to $30, but by the end of the decade, could be at 500. Copper could get down. I'm calling for copper this year at 6. Could get down to $1 and somewhere near $1 in the bust, and then by the end of the decade, could be 20 or 30. So
the forecast that gold could reach $3,000 per ounce by early next year may be conservative. With inflation potentially climbing to high single digits by late 2026, and possibly surpassing 20% by 2030, gold's role as a hedge against rising prices will likely grow in importance. While a gradual decrease in inflation is anticipated to start mid-next year, the ongoing inflationary pressures suggest that gold could exceed $3,000. How high do you think gold prices will climb in the coming years? And what will drive this increase? Share your thoughts in the comments below. If you found this video valuable, like, subscribe, and hit the bell icon for more updates. Thanks for watching, and we'll see you in the next video.